It doesn't make any difference if the US economy goes into downturn or not, the securities exchange for the predictable future is seriously screwed. On a superficial level, the issues confronting the market and the economy might appear to be something very similar. Both are attempting to manage overabundances in any case. Those overabundances are ridiculously unique. On the economy's side, the US is encountering a vicious episode of expansion. Made by the pandemic, repressed request crashed into an absence of everything from laborers to gadgets. Like a multitude of grasshopper, expansion is eating up monetary development, pushing up costs, and invalidating wage increments. Be that as it may, a portion of the pandemic-related conditions that got us here, like stopped-up supply chains, are normalizing, and there's an opportunity we can tackle the separations of the beyond 2 years. Without barreling into an all-out downturn. From November 21, the S&P 500 is as of now down 17.1%. Remembering profits for 2022, all things considered, while the securities exchange has absolutely failed to meet expectations this year, the S&P 500 pullback is not even close to the record of 34 avalanche in WAC 2020 or its 50. Crash, the 2008 to 2009 extraordinary downturn. That is the thing with putting resources into stocks, particularly for the long stretch. There will be occasional pullback. Furthermore, repeating slumps, which are a totally ordinary piece of a sound market. Still, the 2022 market shortcoming up to this point has financial backers concerned that the following enormous move for the stock market could take stock costs even lower. Gareth Soloway, boss market specialist at InTheMoneyStocks.com, shared his contemplations on what he accepted will happen to the economy soon. Before we stand by listening to him, kindly don't forget to crush the like button.
That the dollar going lower is going to signal a start of a bad recession, and it's going to be a recession that looks to get worse and worse and worse. And in those periods, the dollar will go lower, and that will actually hurt stocks in that situation. And it'll hurt stocks because if you have a bad recession, well, guess what? Apple's selling less iPhones, right? Yeah. Microsoft's selling less this and that. So they're going to make less money, and their multiples will have to come down overall. So just be prepared for this little flip going on, where right now a weaker dollar is nice for the stock market because the Fed's involved. Once the Fed gets to neutral, and then we still see the economy cratering, then the dollar will start to fall, even with the stock market. The party is coming to an end. There's no doubt about it. I think that, again, during COVID, and you guys probably experienced it down in Australia as well, people had a lot of savings because they couldn't go do stuff. So it's almost like a kid in a candy store right now, where you get out there, you're like, oh, I'm free finally. I can go buy stuff and travel and this. But then you're like, wait a minute, now I finally ran my credit card debt to its maximum, and I'm out of money. Now what do I do? And that's where you start to see, oh my goodness, now we start to see job losses. And look for this, we're getting a jobs number in early December coming up next week. Look for the US jobs number to start to get worse. And I think that's what you're going to see. You're going to see this pivot point where you're starting to see people lose jobs versus gain. And that's going to be the trigger for people, the consumer, to really pull back on their spending.
Do you think that people really understand that we're going to be hitting a real road bump here?
No, I don't think so. I really don't think that anyone in this new economy has that sense, because basically, if you look at the last 20 years, or at least since 2009, every little hiccup that we've seen, the Fed has come to the rescue, right? Yeah. So we're kind of like a child that is wearing a helmet and a body armor, and like, we can fall down a hill, we can fall off a cliff, and we're fine. We're just like, oh, no big deal. Well, guess what? That security measure, that safety measure is being taken off because the Fed clearly cannot print like they were in the previous cycles, now that we have inflation rising, right? So the average investor is just thinking like, okay, we're in a bear market, but by January or February of 2023, we'll be making new all-time highs, so no big deal. That's what they've experienced, right? That's the experience for the last 13 years at least, if not the last 20. So you have this scenario where people don't think it's real. They don't think the Fed is really taking off the bumpers here. And it's going to be a shock when the Fed, every investor and even big money is going to say, okay, Fed, we're in a recession, please start your printing again. And they're going to say, we can't. Inflation's 4 or 5% still. We can't print. And that's going to be the reckoning day where people freak out. Yes, as soon as the market or investors in general realize that the Fed will not come to the rescue as soon as we tick into a recession, that is going to be a wake-up call for investors. There's no doubt about it. A lot of times what you'll find is when people are most panicked, that's when we're going to get the bounce. But you have to recognize that in bear markets, it's just a bounce, right? So I go long, I go short. I go long, I go short. When I go long, we make money on the move up, but then we're taking it off the table very, very quickly as well. So it's about kind of understanding the macro picture and then understanding human psychology. All of that is all combined into what markets and what stocks do. And by, it essentially helps us guide people through. There's no doubt about it. And I think the key is here, there are investments that you can look towards. Like for instance, gold. You guys know I've loved gold all year long. I said it would be the best performing asset between the S&P and Bitcoin. It obviously was for 2022. I think it will be as well for 2023, although it's a little trickier with Bitcoin now, because as Bitcoin gets to a low, it's a little harder to think about, all right, if it bottoms out in June or May of 2023, where is it by December? So it's a little trickier, but I still would go with the safety of gold with the uncertainty in crypto right now. But I also think that there are other places to look. Like China is actually lowering rates. They just lowered interest rates. It's very risky there, no doubt about it, but I think that that's an opportunity. Brazil looks interesting to me. Their chart is unbelievably coiled. It hasn't made a new all-time high for the Brazilian stock market in something like 13 or 14 years. So it's kind of what I expect for the US stock markets has happened in Brazil for the last 13 years, and it could be getting ready to break out.